Hello and welcome once again to SB Talks. Today is Monday, April 24th, where I am joined again by our Chief Investment Officer, Nick Ryder, to run rule over the world. In our new format, we are aiming to get the podcast out now fortnightly, but have shorter content and more regular updates. Welcome, Nick.
Thanks, Vincent.
Nick, last week saw the release of the report into the review of the Reserve Bank of Australia, and I thought it might be useful just to get your thoughts on if there was anything material you felt positive or negative in terms of the outcome there and what impact it might have, if any, for investors.
Yeah, I mean, it's hard to see how it would necessarily change what the monetary policy approach would be, but I think what it is good in doing is trying to make some more clarity around how the Reserve Bank operates, really reinforce its independence by removing the ability for the Treasurer to overrule the Reserve Bank, to clarify the role of the Treasury Secretary who sits on the Reserve Bank board, that they're really there as an independent person and not necessarily reflecting the government's views.
Right.
And I think also, you know, given the amount of stuff that the RBA board has to cover, separating into the Monetary Policy Committee and a regulatory or oversight committee as a separate board.
So I guess what hats does the RBA currently wear? You've got the printing of money.
Note printing, there's financial stability, there's monetary policy, there's the operations of the Reserve Bank, and don't forget it is actually a bank. Yeah. You know, so there's quite a lot, and I think that's a lot for the board to cover.
And the skill set of someone that's got the right skill set of overseeing some of those areas versus trying to make monetary policy decisions is probably very different hats, very different backgrounds, very different professional expertise.
That's right. Although Governor Lowe, pushed back on the idea. He said that the board functions very well and that the review didn't really sit in on any board meetings. So he was quite defensive about how the board had operated. But I think he generally accepted a lot of the recommendations that were put forward. And
regardless, they are likely to be enacted anyway. And Governor Phil Lowe's own term is up later this year. September, yes. Yeah. So I guess question marks now over whether that will be renewed or not.
Yeah. So the Treasurer has indicated probably in the middle of the year he'll be making a decision as to whether to renew that appointment for another 7 years.
Okay, well, the RBA meets again next week. Might just come back to that one a little bit later on. But before we get there, let's just chat briefly about some of the more interesting bits of data that have come out over late last week and over the weekend. I think inflation numbers out of the UK, PMI numbers out of Europe and the US. What have you seen?
Yeah, so starting with the PMIs, they were generally pretty good. I mean, I think they...
Dare I say, educate the listeners in terms of what a PMI is as well.
So basically a PMI stands for Purchasing Manager Index. It's a survey of basically businesses and they're separated into manufacturing and services. So it's an important pulse check on how businesses are seeing things. And generally the index is, it moves around a level of 50, whereas 50 is neutral. Anything better than 50 means businesses seeing improving conditions, and anything below 50 means things are getting worse and activity is contracting. So
it's one of those indicators that people that are trying to project or see if a recession is coming. This might be one of the signposts that we're on the way there.
Yeah, well, that's right. I mean, I think certainly what we've seen is manufacturing has definitely softened. So we had that sort of, the pandemic-driven boom in demand for goods. And so that saw strength in the manufacturing sector, and that's really started to ease. But it's actually improved a little bit lately. I think maybe the reopening in China has helped some sectors. Not so much Germany, but other parts of Europe have certainly picked up a little bit. But we're still seeing strength in the services sector, PMIs, universally. So that still seems to be a bright part of most economies where people are going out and spending on your restaurants and travel and all those services sectors.
So the question there is the impact that the interest rate rises that we've had to date don't appear to be crushing the economies.
No. So,
at least not yet.
No, there's really no indication, if you look through a lot of the data, that people are really responding to higher interest rates, certainly in the aggregate data so far. So turning to the...
Should we be pleased or concerned by that?
Well, on the one hand, it's good news for economies. We're not heading into a recession, but it's bad news for the fight against inflation. So I think it's at the moment, markets are in a bad news is good news and good news is bad news mode. So anything that's bad about the economy tends to be taken as positive. It lowers interest rates and that boosts equities. So, and vice versa.
So bad news means less likely to have more rate rises or less aggressive rate rises at least to come. Good news, such as the positive PMI data, might mean that actually the Reserve Bank, central banks have further to go.
More work to do, that's
more
right.
Work to do.
And I think that's sort of what I've been trying to say in some of the recent commentary, that I think they do have more work to do, and certainly the PMIs, go to that story.
So show that the interest rates aren't crippling the economies just yet. UK inflation still hanging around in the double-digit territory?
Yeah, they've got all sorts of problems with inflation in the UK. Their food inflation is just under 20%.
Whoa.
And the headline inflation, excluding mortgage costs, has gone back up from 10.1 to 10.4. I think if you build in mortgage costs, it's something like 12 or 13. And then, a lot of people are on strike, and nurses, etc. So they've got all sorts of problems. And wages are 6.6% or something like that in the UK. So yeah, they still have serious issues with inflation.
And what's our next points of reference in terms of the US and here in our inflation outlook?
So the big thing for us is this week, Wednesday morning, we'll get the first quarter CPI print for Australia. It's expected to show a moderation in headline inflation from about 7.8 to 6.9.
Right.
That's what the economists are expecting. And trimmed mean, which is probably the more important measure of inflation, is expected to come down from 6.9 to 6.7. So
maybe explain to the listeners what falls within that definition.
So trimmed mean is basically the RBA's preferred measure of underlying inflation. Basically, they take the items that had the biggest 15% of the increase and the bottom 15% of all item movements, and they chop those out, so they trim it, and then they take the average of the other 70%. So
it's almost they discount the outliers.
Exactly. They try and get rid of the volatile items in the basket and take an average of the other ones, and that's the RBA's preferred measure of underlying inflation, and that's only expected to show a modest fall from 6.9 to 6.7. So still a fair bit of work to do to get back to that 2 to 3% target range, or 2.5% under the new RBA rules guidelines that they recommend is what the RBA kind of follows. So
that then leads us through to next week. Month of May arrives, and the next meeting of the RBA, and following the Silicon Valley Bank and Credit Suisse, there's sort of been a change in the interest rate consensus outlook to saying, okay, we're either very close to being done or done, and increasing expectations that we're going to see even rate cuts before Christmas in the back end of the year, potentially both here and offshore. What do you expect? What's your thoughts in terms of what you expect, not just next week, but for what the rest of the year has in store, given where inflation might be, where PMIs may be, and where the broader economies might still be holding up?
Yeah, so a lot will depend on the inflation data we get next week as to whether the RBA moves again in May. I think there's probably a good chance that they will do another 25. I think what we've seen is pretty much all central banks are data dependent now. So they're not on a preset path. They're really just seeing how the data trickles in, particularly the inflation data. But I think if we go through the RBA minutes from the April meeting, they're certainly not done. There was some concerns expressed about the strength of migration in Australia and what that might mean for demand for goods.
So a reopening of the doors after a trickle for a period of time, but now the migration flow is well and truly on again, and that's going to flow through to the economy.
That's right, and it puts pressure on an economy that's already butting up against full capacity. If you bring in another 400,000 people, there's just not enough supply to go around to meet demand. And so that's certainly one thing the RBA's highlighted. And the other thing they've highlighted is they think wages are going to continue going up, particularly in the second half of the year after we get the next kind of round of award wage reviews and things like that. So So
that begins to become a risk as potentially those wage increases begin to get baked into the system. They're hard to, once they're in there as an expectation, they're hard to remove.
That's right. And, people talking about 5% pay rises for certain categories of workers. So that's what the RBA is certainly concerned about. So that's why I think, there probably is at least one more rate rise, possibly two, possibly three. So I think we're not done. And markets hadn't really been pricing that in.
As much as even the rate announcement, it might be more interesting to read the minutes and to hear the discussion and hear where that ends up. Does any of this change your thinking in terms of your current outlook for investment selection, portfolio construction?
No, I think it's still appropriate to remain underweight in fixed interest. If we take the view that there's still a few more rate rises, maybe over the next sort of 6 months, then it's appropriate to be underweight fixed interest. But it will come a point probably later in the year when we're at the peak in rates, and then we'd be probably looking to neutralise that underweight. For equities, I still think it's a bit of a muddle through year where we get sort of single-digit returns, nothing to get too excited about, but likewise, I don't see a recession, and certainly there's no indications of that in any of the data.
Of a deep recession, at least.
No, well, that's right. We might have a mild technical recession, but I don't really think that that's. I mean, it's so well forecast that it's kind of already in the price to some degree.
Oh, well, thank you very much, Nick, as always. Thank you to all our listeners, and we'll speak with you soon.
Great.
Thank
Thanks.
you.